Hi everybody. So this is my third and final video on the topic of lesser accounting as per IFRS 16 or IND AS 116. Now in my previous two videos, I have taken you through the concept of a finance lease and how a lessor accounts for it. In this video, I will be taking you through how a lessor accounts for an operating lease. Now, before we go ahead, let me reassure you that an operating lease is way simpler than a finance lease.
Hi, I'm Ranjini. Through my videos, I try to simplify complex accounting topics to help you understand them better.
Okay, so we start with this slide. You're familiar with it, that from a lessor's point of view, all leases are divided into finance leases and operating leases. The classification of leases into finance and operating is done based on the risks and rewards of ownership. Here in this video, we are focusing on operating lease. What is an operating lease? An operating lease is a lease in which substantially all the risks and rewards of ownership are retained by the lessor himself. Now, how do we identify if a lease is a finance lease or an operating lease? We look at the conditions of the lease, and if the conditions either individually or in combination indicate a finance lease, then it will not be an operating lease, right? So in my previous videos, I have discussed in detail what are those conditions that identify a finance lease. If you have not gone through it, please do. I have given the link here as well as in the description of the video. Right. So now let's move into accounting for an operating lease. Now in finance lease, we learned that there are two types of lessors, the manufacturer dealer as well as other lessors. The accounting treatment of finance leases was different based on what type of a lessor you are. Thankfully, for an operating lease, it does not matter because the accounting treatment is identical whether you are a manufacturer dealer or a regular lessor. So we start with recognition and measurement. Now, the lease rentals that are received from the lessee are recognized as an income, either on a straight line basis or any other suitable systematic basis. The second is, if any expenses are incurred other than initial direct costs, these are to be expensed out. And finally, it is an operating lease. That means the risks and rewards of ownership are with the lessor. Hence, the asset is also retained by the lessor in the books of accounts. Since the asset is in the lessor's books of accounts, the lessor needs to depreciate the asset. But please note, the depreciation should happen over the economic life of the asset and not just the lease term. Next topic is the initial direct cost. Now, initial direct costs are those costs that are incurred by the lessor in bringing the lease about, either at inception or before. Now, these costs are not to be expensed out. These are to be added to the carrying amount of the asset. Now, what you need to be very careful is while you are calculating depreciation, please do not consider the initial direct cost, because this initial direct cost is to be amortized not over the economic life but over the lease term. So, what do we need to do? We need to amortize the initial direct cost over the lease term using the same basis as the income. Now, like I mentioned, for finance leases, I searched all my sources, but I was not able to find a solved example that shows how a lessor is to account for the initial direct cost. So I have included this in my solved example. But the disclaimer here is this is based on my understanding of how the IDC is to be treated. Before using these in your exams or in your real life, please contact a chartered accountant or an accounts teacher. Also, if you have a different interpretation of how the IDC needs to be accounted, please put that in the comment section below so that I can also learn. Finally, we discussed the topic of lease remeasurement. So, just like in a finance lease, in an operating lease also, the lessor is not supposed to recognize lease remeasurement or a change in the lease based on a reassessment of assumptions made at the inception. But a lessor is to recognize a lease modification, which is a change in the original lease term, scope, or consideration. Right. Now with this, we go and solve an accounting example. Okay, let's read the question. Mr. H leases a car to ply as a taxi from Mr. D for 5 years. The car is not specialized and is expected to have other uses for Mr. D after the lease term. At the commencement of the lease, the car's fair value is $100,000, carrying amount is $80,000, and it has a balanced economic life of 20 years. Mr. D incurs an initial direct cost of $1,000 relating to the lease. The estimated residual value of the car at the end of 20 years is $10,000. The implicit rate of interest is 4%. Mr. H pays Mr. D $5,000 every year at the end of the year. Now, Mr. D allows the first year as a rent-free year as an incentive. Mr. H also agrees to pay 10% of the cab fare that he earns in each year. Cab fare earned in year 1 is $50,000 and in year 2 is $78,000. Mr. H does not have the option to purchase the car at the end of the lease term. What are the accounting entries that will be passed in the first 2 years in the books of Mr. D as per IFRS 16? Alright, so let's make a summary. We know that Mr. H is the lessee and Mr. D is the lessor. The lease term is 5 years. Now, at the commencement of the lease, the car's fair value is 100,000. The carrying amount 80,000 and the economic life 20 years. Mr. D incurs an initial direct cost of 1,000. IDC is 1,000. The residual value is 10,000. There's no information about guaranteed and unguaranteed residual value. The implicit rate of interest 4%. The annual lease rental 5,000 every year, and it is paid at the end of the year. First year is a rent-free year. Mr. H also agrees to pay 10% of the cab fare that he earns in each year. Is this a variable rental based on an index? No, it is a variable lease component that is based on actual usage. So this will not be taken into consideration for any of our calculations. Variable income based on usage. 10% of cab fare. They need to know the accounting entries that will be passed in the first 2 years. Now, in any lease question for a lessor, you need to find out whether it is a finance lease or an operating lease. In our working notes, working note 1 is finance lease or operating lease. Let's look at the obvious conditions. First is that the lease term is 5 years and the economic life is 20 years. So definitely it does not cover substantially all of the economic life. We know that the car is not specialized in nature and that Mr. H can neither purchase nor extend the lease term. Therefore, all these conditions are indicators of an operating lease. Let's look at the final condition, and that is whether the annual lease rentals will substantially cover the fair value of the asset. So let's calculate the present value of the lease payments. From the second year to the 5th year, there is annual rental. Why not the first year? Because the first year was given as a rent-free period. 5,000 is paid yearly. What will the discounting factor be? So this is actually the annuity factor. If you do not know how to do this, please refer to my video on how to calculate the present value. Over here, you must make sure that you skip out the discounting factor relating to the first year, 3.4899, and the payment based on the cab fare, that will not be considered here. It will be recognized when it is earned only. So we have the discounted cash flow at 17,500. The fair value is 100,000. It is nowhere covering the fair value of the asset. So we can safely conclude that this is an operating lease. We need to recognize the lease rentals received as an income. Over here, the straight line basis makes sense as we receive equal rentals every year. Working note 2 is calculation of yearly rental income. Will we consider 5,000 for every year? No, we won't, because we are not receiving 5,000 every year. The first year is considered as a rent-free period. We need to recognize the income as and when it is accrued. So our total lease rental, 5,000 multiplied by 4, which is 20,000. Lease term is 5 years. The annual rental income, 4,000. Working note 3, amortization of IDC. The total IDC is 1,000. Lease term is 5 years. So annual amortization $200 every year. Finally, the working note 4 is depreciation of car. Year opening balance depreciation. The opening balance on which the depreciation is to be calculated is here the carrying amount. We will not include the IDC. Carrying amount is 80,000. Less, we have a residual value of 10,000 at the end of the economic life of 20 years. This will be divided by 20. 3,500 every year. The opening balance in the next year is carrying value minus depreciation. The depreciation amount stays the same. Now let's go to the solution, which is journal entries. First, at the inception, we incur initial direct cost account debit 1,000 bank. This is to be added to the carrying amount of the car. So car account debit to. At the end of first year, we first recognize the lease rental income. Have we received the lease rental income? No. Lease rent receivable account debit 4,000 to lease rental 4,000. Then there is the amortization of the initial direct cost. IDC amortization account debit to car on lease account 200. And then you do receive a variable lease rental that is based on the cab fare. In the first year, the cab fare is 50,000. So you receive 5,000. Bank account debit to other income from lease 5,000. Finally, the entry on depreciation. Depreciation account debit 3,500 to. Now, what all goes to the P&L account? We have a lease rental of 4,000. We have other income from lease 5,000. You have IDC amortization 200, depreciation 3,500. The remaining goes to the P&L. At the end of second year, we will actually receive some money towards lease rental. Bank account debit. We receive 5,000, which is the lease rental for the year. We also receive some variable pay, and that is 10% of the cab fare of 78,000, which is 7,800. Annual rental plus the lease rent receivable is 4,000. To other income from lease 7,800. The remaining goes towards lease rental 1,000. So out of an accrued income of 4,000 in year 2, we receive only actually 1,000, which means the remaining is to be put as lease rent receivable to lease rental 3,000. So in this year also an income of 3,000 plus 1,000, 4,000 is recognized. Okay, great. Now we go to our amortization. IDC amortization 200 to car on lease. We also have depreciation 3,500 to cumulative depreciation 3,500. Now we take all of this into the P&L account. Lease rent 4,000, other income from lease 7,800, to IDC amortized 200, to depreciation 3,500, to P&L, and that is 8,100. Okay, that brings us to the end of this example on operating leases. It is also the end of the series on lesser accounting. I have one more topic to cover under this standard, and that is sale and leaseback transactions. I will be taking that up in the upcoming videos. So we are nearing the end of the topic IFRS 16 or IND AS 116 on leases. I thank you very much for watching this video and all my other videos. I welcome all your thoughts, your comments, your suggestions for improvements on this video. I hope to see you in my next video. Thanks very much for watching. I hope you found this video helpful. Bye.